Good evening, everyone. I'm Laurent Deville, Professor of Finance at EDHEC Business School, and tonight I will be hosting this episode of the EDHEC Business School Future of Finance Speaker Series, where Cynthia Balloch, Assistant Professor at the London School of Economics and Political Science, will address the question of the performance of private equity, not as an asset class globally, but more specifically for the case of individual investors. So I'm going to start by briefly introducing Cynthia Balloch, who has followed a very interesting path for a financial scholar. So she does have professional experience, which is not that common for the academia. So indeed, she worked for 4 years in the industry as an investment analyst before coming back to academia and completing her PhD at Columbia University. So that's not frequent, university, business school. And having this opportunity to discuss with scholars who have this double hat and understand the question from the core of the industry, that's very what we're looking for too. So that the question that matters not only for the collective knowledge, but also the questions that have relevance for market and players. Tonight, we're very proud to host Cynthia to discuss the results and implications of her research on the democratization of private markets. So this topic is currently experiencing growing interest from the industry, the regulators, but also the press, sometimes with the fear that this opportunity that individual investors are getting to invest in private assets comes at a time where the perspective is darkening for future performance. So looking at how individual investors have performed in this asset class in the past should give us a first answer regarding whether this additional investment opportunity should be viewed as relevant in the current conditions. So after your talk, Cynthia, we'll have the chance to start, or within the talk, we'll have the chance to start discussion with Professor Hamid Boustanifar from EDHEC Business School, and who also acts as the director of the MSc in Corporate Finance and Banking, and Nadia Kamtoun, who is one of the proud students of this program. For the audience, do not hesitate to share your thoughts and write questions within the Q&A. I will be able to route the questions to Cynthia. So thanks for the three of you to be with us tonight, Cynthia, Hamid, and Nadia. And now, Cynthia, without further ado, the floor is yours for the next 30 to 35 minutes. Thank you very much.
Okay, thank you, Laurent, very much for the introduction. I will just try to share my slides. Can tell me that you see the slides, yes?
This is perfect. Thank you very much.
Perfect. Okay, great. So as Laurent explained, the research that I'll be presenting today is a project in which we look at the private equity performance of individual investors. This is a interesting area because there's a lot of discussion in markets at the moment about the so-called democratization of private markets. And we think that we have something interesting to say into this debate. So this is joint work with Federico Mainardi and Sangmin Oh at Columbia Business School and Petra Vocata at Ohio State University. Okay, so why are we focused on individual investors in private equity? This is not typically who we think of as being the investor base associated with private equity assets. Globally, the estimates state that there are about 8 trillion of these assets, so it's a very large market. And current market estimates put the individual share of these 8 trillion at about 1 trillion. So this is already a significant chunk of the investments in private equity. But importantly, investors who are individuals are increasingly being targeted by private equity funds as potential sources of future capital. So some of the industry estimates are that the individual share in private equity will grow much faster than the other segments of private equity, that it may be up to half of the new commitments of capital that are going to private equity funds that are being raised in the near future. And at the same time, and contributing to this, there's a lot of policy debate around whether access should be expanded further. And there are a number of policy proposals that introduce more investment products or broaden the scope of existing investment products to include private equity. So we think that this raises some important questions. First and foremost, how do individual investors perform in private equity when they get access to this investment class? What we're able to do in this study is provide the first systematic data-based analysis of individual investors' performance in private equity. And the way that we want to think about performance is through the lens of intermediation frictions. So, from an academic perspective, we can think about frictions such as access to private equity funds. This could mean, that individual investors get access to a selected subset of private equity funds because there's some adverse selection in the private equity market, and in particular, adverse selection in the funds that are marketed to individual investors. However, this might be mitigated by the fact that funds would like to raise capital continually, so they would be a little bit worried about offering adversely selected funds to investors that they want to access more than once. There could be differences between individual investors and institutional investors in terms of the amount of skill that they bring to evaluating private equity investments, because an individual investor is likely to have a far smaller team than a large endowment or a foundation. And so there might be differences in the amount of skill that they can bring to selecting which investments they'd like to make and doing that in a way that's correlated with performance. Finally, there are likely to be, as is the case with many individual investment products, different fees that are levied on the products when individuals invest in them. So what we'll do in this study is try to use the data that we have to shed light on these different types of intermediation frictions and understand how these intermediation frictions affect ultimately individual investors' performance. So we'll look at this both on average, looking at the fund universe that individual investors invest in. And then in the second half of the talk, I'll focus on how these different frictions weigh on the cross-section of investors according to their wealth. So I'll look at these two kind of dimensions of the data.
Cynthia, can I ask you just one question there? So we're looking at the past performance, am I right? And my question is that, are we confident that the future of private equity will look like the past of private equity? Because sometimes I have the feeling that this industry may be reinventing itself. So do we think that this kind of capture of the past will allow you to confidently look at the future, but I guess we should look at with caution at that. But yeah, that's the question that I wanted to ask you.
Absolutely. So there are very strong effects in terms of the timing of investment performance in private equity. This we will make clear in some pictures that we'll show. We have no confidence that past performance will predict future performance. What we do provide in our analysis is two sets of benchmarks. So we look at how individual performance compares to institutional performance. So we think if institutional trends are going in a particular way, we could understand individuals' performance relative to institutions. We'll also talk a little bit about historical performance relative to public markets, but this, of course, we think is very likely to change. Secondly, we'll focus on the cross-sectional differences within the wealth distribution. So these, I think, are different ways of thinking about benchmarking performance, even though we understand that future performance may not look like past performance.
Thank you very much. Very clear.
Okay, super. All right, so to be clear about what data we do have and what data we'll be basing our analysis on today, we have data in this paper that we analyze on 18,000 individual investors in the US. These investors range in wealth from investors who are really at the kind of cutoff for who would be a marginal investor in a private equity investment in the US because they are just barely at the threshold of being accredited to invest in private equity, all the way up to a significant number of billionaires. So we really do have data on investors who span the top part of the wealth distribution, and we think that we have a pretty good representative sample for those groups of people. Across these 18,000 investors, they've made 64,000 investments. These are investments that range from kind of 10,000 US dollars to 5 million US dollars. And the underlying investments that they've invested in are 4,500 individual private equity funds. We divide private equity or define private equity here in terms of funds that are in kind of buyout, venture capital, or in either of those two categories, funds of funds. We'll look only at vintages from 2000 to 2020 so that we can really be very careful about comparing the performance of those funds to the funds of institutional investors over that same time period. To give a preview of the results that I'll talk through over the next 20 minutes, the kind of main findings in our paper are four. So what I will show is that the funds that the individuals in our data have invested in have similar performance as the funds that have been invested in by institutional investors. So this is quite important, and it sheds light on this first friction in that we don't think that there's a lot of adverse selection in the funds that individuals have gotten access to in the past. However, when we look across the wealth distribution, what we find is that the most affluent investors in our sample are outperforming the least affluent investors by about 9 percentage points in PME. For those of you who aren't familiar with this performance measure, I will describe it in detail in a couple of slides, but we do find that this is a quantitative gap between the performance of the very wealthy and the performance of people who we would term merely affluent. We do find that the financial advisors that these individuals have are very important in explaining the performance differences that we find. They provide typically quite consistent advice across the individuals whose portfolios they manage, and they are able to provide persistent performance. So this holds for a subsample of investors, of advisors who are able to consistently select higher performing funds. And we think that this is evidence of skill rather than access because we can show that it holds in subsamples of funds where access frictions are understood to be relatively small. When we come to the question of fees, what we find is that fees amplify the performance gap in fund selection that is correlated with the advisor that an individual has. And this increases the difference between the performance of the wealthiest and the least wealthy in the sample by more than 50%. So these fees are going to be really important, and I'll talk through how we come up with these four results through the following slides in my talk.
Just a question now that we are in the data part you were explaining, maybe for those who are interested potentially to have access to this data, maybe you could explain, how you get it and whether there is public access or so. I suppose there is no easy way of getting it, but just for the information would be nice.
Yes, absolutely. So I think my next slide will be about the data. I can talk about the data in detail. The data that we're using here is principally data that comes from Adapar. So this is a technology and wealth data management platform. You can look it up online. It has data that is provided by wealth managers to the platform because the platform provides the wealth managers with performance reporting and analytics software that they use to help report back on the performance of the portfolios they manage to their clients. This company is really excited about the data that they've had, and they've allowed us to use it in a couple of different research contexts so far. I do believe that in the future, they would like to be able to partner with academics on a more consistent basis, but this has been in a relatively small implementation thus far. So we're lucky that we have access to this data. It's unfortunately not public, and it is also, I would say, very carefully anonymized to protect the identities of the investors and the advisors in our sample. So this is a quite important thing that I should mention. But we do use the cash flows and the valuations that are reported from GPs to these advisors as the basis of our analysis of private equity performance. Okay, so I mentioned how big the sample was previously. Laurent, do you have another question?
No, I had a question with respect to that. So you have some kind of a subsample of the investment in private equity by individual investors. So you have a selected wealth managers that provide information to this kind of platform. And do you think there is a bias in the type of wealth managers who are using this platform with respect to the global average wealth manager? So maybe the more skilled are using that, or the less skilled are using this platform? The
Okay.
larger, the smallest? I don't know whether you have the answer, but I would
So
be curious.
either of those things could be possible. It might be that people who are very, very good at choosing private equity investments don't even want a financial advisor, so they're not on the platform. It could be that the advisors that are kind of better skilled and better able to select investments don't need this software. The way that we test for this type of selection is twofold. So first of all, we look at how representative our investors look relative to survey data and other estimates of what portfolios look like across the wealth distribution. So there's a lot of work that's been done by other eminent economists to try to document this using either data from the Survey of Consumer Finances in the US or using tax data. And in both cases, we think that what we find in terms of our investors looks representative relative to what we're able to observe there. In terms of the selection of advisors, the way that we test for selection in the advisors on the platform is to look for trends in performance according to when advisors joined the platform. So if this was something that like only the best financial advisors used and then more and more financial advisors gradually joined, what we would expect to see is a downward trend in performance according to the time at which an advisor joined the platform. And all of the analysis that we've done on this looks like the kind of relationship between performance and when advisors joined the platform looks very, very stable. So we don't think that there's selection in who is on the platform, although we can't entirely rule it out. Okay, so these advisors that we have on the platform, there's 745 of them. These include registered investment advisors, broker-dealers, and family offices. We'll talk a little bit about those different institutional types. The other types of summary statistics here I've said already, so I won't repeat them. The other thing that we'll use as data in this project is two sources of institutional data on private equity performance. So we'll use Preqin as a source of fund characteristics and then as one benchmark for institutional performance. And we will also use MSCI Private Capital Universe. This was previously known as Burgess. This is another institutional benchmark for private equity performance, which is sourced from confidential LP data, so is considered to be a little bit more reliable in some settings than Preqin. Okay, so that we have a sense of who it is that we'll analyze in the following slides in the paper, what I'm showing here is just some summary statistics about the investors. I had said that we had 18,000 of them. What I am doing here is breaking them out into about 5 wealth groups that are increasing in wealth. So what you can see here is that in the different wealth groups that we have selected, we have about 3,000 investors or 4,000 investors in each group. The least wealthy investors in our sample, who we qualify as being investors with less than 3 million in assets under management, have on average about 2 million in assets under management. They've made 2 investments in private equity, have invested about $200,000 in total, and their shares of private equity are tilted more heavily towards funds of funds than buyouts or venture capital on average. The median commitment that they are making to a private equity fund is about $100,000 at a time. So this, of course, increases with wealth. As investors become wealthier, they invest in more funds. They invest in more funds directly as opposed to using a fund-of-fund structure. The commitments that they make to funds are increasing in wealth. But even for the wealthiest investors in our sample, we find that the commitments that they are making to private equity funds are much smaller than the commitments that we typically associate with institutional investments in private equity. In other work, this number has been shown to be around 5 million. Even for the least wealthy investors in our sample, they're writing checks or making commitments of about 1.5 million at the median. And of course, for the less wealthy investors in the sample, the number is even lower than that. So we think that this is kind of evidence of a shift in the structure of the industry that is trying to target more carefully these individual investors by requiring lower fund commitments. And we'll talk a little bit about that later on. The last thing I want to say here is that the funds that we have in our data are not the same funds as the funds in the institutional data sets. So if the funds that we had in our data were exactly the same as the funds that were covered in Preqin or Burgess, then the fact that we find similar performance to institutional investors would just be like by construction. But when we compare with Preqin, because we can compare name by name, and when we compare with Burgess, because we can count how many funds we have in each vintage, in each strategy, we find that we have 2,000 funds that individual investors have invested in that don't have performance data in Preqin, and we have more than 1,000 funds that we observe individual investors investing in that are not funds that are being covered in the Burgess institutional benchmarks. So this is a different universe of funds that is being marketed towards individual investors, and this makes the question of whether the performance of these funds relative to the institutional benchmarks is different, an interesting question.
Excuse me, do you know why there are a large set of them that they do not show up there in Preqin and Burgess? Is there a reason, like a systematic sort of reason?
So there are a lot of funds that don't provide data to Preqin. If you look at the number of funds that Preqin can identify just by name, what you can see is that there's quite a lot of GPs that don't provide any sort of performance data to Preqin voluntarily. Of course, Preqin is able to source additional performance data from investors by making FOIA requests. That's like a Freedom of Information Act request where they tell a large investor, typically one that has public funding, that they would like to see the performance data and then they can add it to their databases. They're often not able to do that for funds that are invested in for individual investors. So similarly, Burgess's data sources typically come from institutional LPs. These will be funds that are simply outside of the investment universe of what investors at an institutional level have been investing in over these vintages.
Did you also look at the funds that are overlapping between your data set and Burgess? And I guess you have done that. So
yes, we've done that. So this is tricky. I think if I click on this, I could show you that. All right. Okay. So here what I'm showing in blue is a plot of the number of funds by vintage that we have in our data relative to the number of funds that Preqin has in its data by vintage. And then in the blue shaded area, I'm showing the overlap. So what you can see is that in the 2000s, the data coverage in the data that we have is low relative to Preqin. It's on the same order of magnitude, but it's really within funds that have been marketed over the last 10 years of our sample that there are a substantial number of funds that individual investors have invested in that are not covered in Preqin, which would be like the difference between this upper line and the overlap. Okay, so what we do with the data that we have on these funds is we calculate the standard performance metrics in the private equity industry that are based on cash flows. We're going to do this first net of GP fees, and then I'll talk about the other fees that apply to an individual investor's case. So the TVPI multiple of a private equity fund is a very simple metric to understand. It represents the amount of money that the fund has distributed back to investors, plus the current NAV of the fund, divided by the amount of money that was invested in the fund. So this gives us a really easy understanding of how much money the fund has generated relative to the amount of money that was invested in the fund, but it isn't time weighted or doesn't take into account the time value of money, which the IRR does. There are limitations to thinking about an IRR in particular. There's no real adjustment for risk, and there's no real adjustment for what you could have invested in instead of having invested in private equity. So the metrics that we'll focus on in the presentation today are PME-based metrics. The most famous one of these is the Kaplan and Shor PME, which calculates how much an investor makes relative to having invested the same dollars in a public equity benchmark at the same times that the private equity investments were being made. We're going to do one step more complex than that because we understand that the risk in private equity is not necessarily the same as the risk in public markets. So we will risk adjust the PMEs following a method in a paper by Greg Brown and co-authors. We also show in the paper a measure of alpha by Arthur Korteweg and Stefan Nagel. This is a robustness. All of our results hold across all of these measures, so it's really a matter of taste which one you want to look at. I will focus on measure number 2 in the results I'll show today. So if we think about where the levels of these performance metrics are, we will think about this across the different categories of funds in our data. On average, these funds are returning about $2 for every dollar that has been invested. That's what we see in the first row here. In terms of IRRs, the IRR in buyout is around 17%. It's lower on average in VC and fund of funds. When we look at the PMEs, the Kaplan-Shore PME is higher than 1. This means that you made more money in private equity than you would have made had you invested in public equities dollar for dollar over the same vintages that we observe when those cash flows were called and distributed. But if we risk adjust this measure of PME, of course, performance goes down. So in particular, buyouts do appear to outperform public markets on average for the vintages that we observe. VC, we understand to have a beta that is higher than 1. So when we risk adjust the PME of VC, it goes down. It's about comparable to public markets. And for fund of funds, similarly, the PME is a little bit above 1. And if we apply a more aggressive risk adjustment, which we've done in this high beta PME category, the performance becomes lower. Still, we are not going to emphasize the results of performance relative to public markets much in the remainder of the talk because this very much depends on whether or how much you assume there is risk in these markets. Okay, so I said that I would be talking about more types of fees than GP fees. I want to make that very clear here before I go forward. What we're going to focus on for the next 8 slides or so is the median performance of a fund across its investors, net of GP fees. So this is net of the typical management and carry fees that are being charged by a GP to its LPs. This can vary across investors. So this was shown in an important paper by Julian Beguenau and Emile Sirawardane. We will talk about the different ability of individual investors to negotiate fee exceptions or side letters with GPs as a separate set of analysis at the end. In addition to that, what we'll characterize at the very end of the talk are access fees that are being charged by platforms or feeder funds that are specially designed to give individual investors access to private equity, and then advisory fees, which are the advisors' fees being charged to the investor in order to make private equity fund selections. Okay, but for the moment, we're going to focus just on this first fee, net of GP fees, and then at the end, we'll come back to this net fee concept. Okay, so to talk about performance, now that we have that set up out of the way, the first thing I want to show is that the performance of individual investors in private equity looks very similar to the institutional benchmarks in Preqin or Burgess. Here, what I'm showing is the performance of the median fund by vintage and category over time in blue for the individual investors, relative to Preqin in dark green and Burgess in light green. So you can see for buyout and VC, there's like very little difference between any of these lines. What we can take that to mean is that there's very little difference in the performance of the funds that individual investors have selected relative to the median performance of the funds that institutional investors have selected. What Laurent mentioned at the beginning about the potential future performance of private equity alludes to the idea, in particular for buyout, that we have seen a downwards trend in performance over time. But we think that the main takeaway that we wanted to focus on here is the idea that there isn't much difference in what's being marketed to individual investors relative to institutional investors. For funds of funds, what we can see is that there's actually a very big gap between Preqin and Burgess in terms of where the benchmarks have been over the last few years. So this is, I think, what many people have in mind when they think of Burgess as being a higher quality data source than Preqin, because they're concerned that there's potentially some upwards bias in the Preqin data. What we find is that our individual investors' investments in fund of funds really kind of is in the middle of these two benchmarks. So this is obviously just a picture. We can also do some statistical tests to ask ourselves whether there is any statistically significant excess performance of the funds that individuals invest in on average relative to the benchmark for either Preqin or Burgess for the vintage and category of the fund that individual investors have invested in. So this is a question that we can ask either like on an equal weighted basis or on a value weighted basis. And what I'm showing here is the estimates and the statistical significance of excess performance relative to the two benchmarks for the three categories for either equal weighted or value weighted portfolios. And what we find is that whether or not performance is positive on average relative to benchmarks is really sensitive to the choice of performance metric, and it's really sensitive to the benchmark. For example, for buyout on a value weighted basis, we find that the individual investors, they underperform Preqin, but they outperform Burgess. For VC, we find outperformance relative to both benchmarks. And then again, for funds of funds, what we find is that there's positive excess performance relative to Burgess and negative excess performance relative to Preqin. So what we think is important to take away here is that we really don't find systematic evidence that the funds that are being marketed or have been marketed in the past to individual investors are systematically underperforming institutional benchmarks. And in particular, what we find is the magnitudes are much smaller than the differences documented in the existing literature. So in other papers, it's been shown that there's more of a 20% IRR gap across the performance of institutional investors on an IRR basis. These gaps are on the order of 4 to 5%. So we don't find that there's that big of a difference between the performance of our investors and the performance of institutions.
Do you observe any evolution over time over that excess performance as you calculate it? Does it evolve, or is it something that remains pretty stable?
So I don't have a test of that. I don't think specifically. We would refer, I guess, to looking at this chart again, but that's not a statistical test. So if I want to statistically test whether there's a trend in excess performance, no, that's not something I don't think that we've done, but that's a good suggestion. I will implement that.
I also have a clarification question. So the funds that they are advertised to individuals that we know on individuals they have invested, and we don't have it in Burgess or Preqin. We don't know whether institutions they are also investing there, and they are for any reason they are not reporting it to Preqin, right? Is that?
Yes. So we would potentially overstate the number of funds that are only invested in by individual investors if those funds also have institutional investors who've chosen, or GPs who've chosen not to disclose that data to Preqin. You can't selectively remove things from your portfolio if you're forced to do a FOIA disclosure. We have done some analysis to look at whether there's any sort of systematic difference in performance between the funds that are like in one data set versus in the overlap between the two data sets. And we don't find that there's a big pattern of difference between the overlap and the kind of outsets of those two.
Okay. No, I just wanted to make sure that, so it's not that you have some information that these are only advertised to individual, some indicator on the fund that this is not open to institutions. This is just for individuals.
No, we haven't looked at that specifically, although we could, I think, identify some GPs that typically market funds to individual investors. I think that is something that some GPs are associated with that we could potentially measure separately. I think one of the typical concerns that we have with institutional benchmarks is that because Preqin does allow GPs to provide data to them, there is some positive selection in the data that ends up on the Preqin platform. So one of the kind of interpretations of the fact that we find negative excess performance relative to Preqin is that when you allow GPs to tell you what their performance was, they're going to do so in a way that's selective, whereas our data does not have that problem. Yeah. Okay. So leaving aside now the comparison to institutions, what I want to focus on next is this wealth gap in performance. So we talked about investors that were across the top of the wealth distribution in performance, across the top of the wealth distribution in the US. What I'm going to do now is take this concept of the risk-adjusted PME and run a regression in which I include a dummy variable for each one of the wealth groups that I had outlined in the summary statistics table. So this gives us a sense of the level of performance across investors as they move up the wealth distribution. We'll control in these regressions for category time fixed effects, and later we'll control for advisor fixed effects, but I will walk through those adjustments one by one. So this looks like a lot of numbers. Let me try to talk through this clearly. The first regression that I am showing is just quantifying the statistical difference in performance of an individual on average who has less than 3 million in assets under management relative to the emitted group, which are the investors with more than 100 million in wealth. So what I would like you to take away from this first column is just that there's an 8 percentage point gap between investors who are at the very top of the wealth distribution and the investors that we would qualify as being the least affluent in our sample. This doesn't control for anything in the first column. That's important as a benchmark because one of the big hypotheses for why there are differences in performance across investors in private equity is because they choose to invest in private equity, buyout funds, or venture capital funds at the right times. So we can, in the second column, control for category vintage fixed effects. And what we find in the second column is that only about 2 percentage points of this 7.5 percentage point gap can be explained by the selection of categories and vintages, like choosing to invest in VC at the right time. So that's not what is driving the wealth gap. We can look at the wealth gap across different categories of funds. We find that it is largely being driven by selection of venture capital investments. That's important because we understand that venture capital is one of the areas in which it's most difficult to make investment selections because there are a lot of funds that are very small. In funds of funds, we also find a significant wealth gap. What we do in this last column is we include in the specification advisor fixed effects. So this is interesting because what it is telling us is that for the advisors in our sample, once we control for their identities across the individuals who they advise, we find that there's no statistically significant remaining wealth gap in performance across investors. So this is telling us that the advisors are playing a significant role in determining what funds individual investors end up investing in. Okay, so with that fact established, what we want to spend the remaining time on is talking about the role of intermediation frictions. One way of thinking about how important advisors are in explaining performance variation is to think about what R squared they would have in a regression of standardized performance. So if we take the performance that we have and we standardize it across categories and vintages, so the variances across the categories and vintages are all the same, what we can do is run a regression in which we have an advisor category vintage fixed effect for each advisor in each category and vintage that they've invested. What we find is that the advisors give really consistent PE advice across clients. The R squared of this regression is like 64%. So that means that these advisors are explaining about 2/3 of the variation in the portfolios that these investors have in terms of their performance. And within advisors, what we find is that 72% of the observations are identical to the advisor category vintage mean. So within the advisors that we have, we really see people making very highly correlated investments. One explanation for this could be that people with similar preferences choose the same advisor. We think we can rule that out because we can also see these investors' public equity performances. So when we look at the performance of public equity and we control for a similar advisor year-month fixed effect for positions that are being taken in the public stock market, what we find is the corresponding R-squared is less than half of the R-squared that we find in private equity. So we conclude from that these advisors are playing an outsized role in the private equity performance of their clients. So what we want to now do is unpack how this performance is related to advisor characteristics. We're going to do that through regressions in which we include the wealth groups that we had before, but we add to the wealth groups characteristics that are based on the advisors, either the type of advisor they are or what their past experience and performance in private equity has been. So here I'm suppressing the fixed effects that I had shown in the previous table, and I am coming up with a variable that is like the performance quartile of an investor that's based on the average excess performance of an investor over the last 4 vintages in the category that they're making a new investment in. So what we find here is that advisors who've had higher performance in the past have higher performance in the investments they select in current vintages. These are quartiles, so this is about a 5 percentage point performance gap. For someone who's in the top quartile, that's going to be multiplied by 3. So this is going to end up to be a very sizable performance gap if you've had experience investing in private equity in the past, and that experience has been associated with high performance. The second explanatory variable that we include here is the number of past funds that you've invested in, scaled by hundreds. So 100 more funds of experience is associated with a 2.5 percentage point higher performance when you select a fund in the current vintage. The important thing to point out in the comparison between column 1 and column 2 is that this is not just about size. This is about actual skill. When we include the amount of money that they're investing or the amount of money that they manage, we don't find that those coefficients show up positively at all. We also find that this is true within the subsample of investors who are making their first private equity investment. Of course, this is a much smaller sample than the overall group that we include, but we do find that experience matters for new investors as well as all of the investors. So we're going to argue that this is driven by skill by looking at how these coefficients change within subsamples that it is understood it is relatively easy for people to have access to. These subsamples are when GPs are raising their very first fund. This is in column 2. Here I've repeated the specification from the previous table in column 1 just for comparability. But when we select only the funds that are the first funds being raised by a new GP, so this GP doesn't have connections, it doesn't have a network of prior investors, what we find is that past performance at the advisor level and advisor experience are quantitatively very similar to what we find in the full sample. This is also the case within funds with minimum commitments of less than $1 million and funds with average commitments of less than 100,000. So if anything, we find a larger role for performance and experience in the selection of these funds. By contrast, funds that are difficult to access or funds that are oversubscribed, these are funds that have more demand than they would like to be able to raise. We don't find evidence that there is a statistically significant impact of performance or experience in this sample. So we take this as being evidence that skill matters and that this skill matters at the advisor level in a way that investors benefit from. Okay.
Cynthia, I have a question.
Yes.
Please, I want to know for you if the strategy of GPs like the leverage buyout, if the GPs do co-investment, though this could have a significant impact on the performance also.
Okay, so we've excluded co-investments from the sample.
Okay.
And we do find that there are differences in how like leveraged buyouts as a strategy perform relative to other strategies. So when I looked at the performance across investors, the way that we can think about the performance of like leveraged buyouts relative to venture capital or funds of funds is by looking at like what the constant here is. So this gives us a sense of where the level of performance would be. We do find, and don't spend a lot of time emphasizing, that there doesn't seem to be a significant role for intermediation frictions within buyout. So you'll notice within buyout, there's no statistically significant relationship between wealth and performance, whereas we do find that for VC and funds of funds. So we think that the frictions that we're focused on are really going to be more relevant in venture capital and funds of funds rather than in buyout. Okay, so I have no idea how much longer I'm allowed to speak for.
I think we're running the discussion as it goes by,
Right.
Cynthia. We still have 15 minutes globally, so
Okay.
so I don't know how much time you need. That I still have so many questions to ask, and I'm sure this is the same for Amit
All
and
right. So
Nadia.
let me let me spend like 3 or 4 more minutes on the remaining findings of our research, which I think are important, and I'll try to do this expediently so we have time for your questions. Okay.
Very good.
All right. So, of course, the advisors matter, and we do find this wealth gradient across the investors in our sample. What this implies is that there is sorting by investors' quality, by investors' wealth and advisor quality. What I'm showing here is like the average performance quartile of an investor as they move from the lowest wealth group to the top wealth group. On average, if you're a wealthy investor, you're more likely to have an advisor who is high quality, who's had high past performance, but it isn't perfect sorting. In particular, kind of more than a third of the wealthiest investors in the sample have an advisor who's kind of in the bottom half of performance. But this sorting between investors and advisors is what's going to drive the performance gap initially across investors. Okay, so before I conclude, I do want to talk about these additional fees. They are quantitatively important, and they are going to add to the performance gap across the wealth distribution. I talked briefly about this before, but just to remind you, we understand that investors or advisors have a differential ability to negotiate with GPs what the terms of the contract they are getting as an LP that's been showed elsewhere. We can observe this in our data, so we'll just measure it and then extrapolate it by wealth for those of whom we don't observe it directly. When we can see someone is being charged an access fee by a platform or a feeder fund, we'll capture that as well. And then we don't cleanly observe the fees charged by wealth advisors, but we can see in disclosures that wealth advisors make what the fee schedule of these advisors looks like. So we're going to charge a simulated fee on individual investors, investments in private equity based on one of these fee disclosures that we can see is decreasing in wealth. It's going to start at about 1.5 percentage points for the least wealthy in the sample, and it will decline as people become wealthier to about 50 basis points. So when we measure all of these different types of fees, what we end up with is a measure of the performance gap that widens net of all of the fees that individual investors are being charged. If we just look at the difference in performance based on asset selection, what we end up with is this dark blue bar, which is lower for the least wealthy group than for the highest wealth group. And the ability of these individual investors or their advisors to negotiate terms with the GP does magnify this performance gap a little bit. The access fees that we observe tend to be very small, so these are typically very limited as a percentage of the investments that individuals make. What does make a bigger difference is the advisory fee. We can see that advisors are charging a significant share of the surplus that they're able to generate through these investments. And in particular, for the least wealthy investors in the sample, this is something that is going to completely offset their outperformance relative to public markets. So we do think that this is an important fee to keep in mind, and we do think that these estimates are relevant as we think about the broader debate about democratization in this industry. So what I'm showing in this research is that we are able to determined that in the past, anyway, individuals have been marketed funds that are similar to the funds that have been invested by institutions. There is, however, a significant wealth gradient, and the financial advisors play a primary role in driving this wealth gradient. Fees amplify this gradient and disproportionately affect the less wealthy. So we do think that this has policy implications in that when we think about what types of products are involved in any sort of democratization, we want to think very carefully about what funds are being selected and included in these investment products and what the fee structures of these investment products look like. So the success or the potential benefits for individual investors in this market are really going to hinge on successfully alleviating these frictions. I think that's kind of a general result. And I'm happy at this point to take your questions.
Thank you very much for this very insightful presentation, Cynthia. Amit, maybe you want you have a few questions, or Nadia, and then I can move on with a last one or something like that.
Yeah. I mean, since I ask a lot of questions, I don't want to also take too much of time for me, but I think maybe, on at least the policy implication, and that's where you started and you kind of finished by that as well, which is very important. And now, as you showed, this very least affluent, poorer, relatively speaking, people, they were the losers in a way in these investments. And I don't know how much of the results that you showed and you have done and what your views are on the, really like the clear policy implication. Is it that, the fees has to be kind of quite transparent or like a cap on the fees, or would it be that, well, basically we just increase the minimum so that, the poor people, relatively poorer people, they cannot invest, or what kind of things your results can tell about the mechanism to help them,
Yes. Okay. So I think the way that we have kind of structured our thoughts on the democratization debate is that if we were to just lower the thresholds for accreditation, so if you're just going to lower minimum commitments or increase the pool of investors that are able to have access to this asset class, that's really not going to help with any of the relevant frictions that seem to be weighing on investors' performance. This has been the trend over the last kind of decade. We do see a significant rise in funds that are being marketed as having a low minimum commitment that don't require necessarily accreditation because of the way that they're marketed. Those types of changes in eligibility and thresholds are really unlikely to be associated with performance that is positive relative to public markets for investors who are kind of around this threshold. That said, I do think that it is a separate set of products and a separate set of debates over like new platforms and vehicles. So what we do find is that like there are a lot of platforms that are designed to be able to kind of pool investors' capital and to provide access at a relatively low fee for individual investors. And those types of products seem to have more promise because they are able to provide access without providing necessarily such a high fee base.
Sorry.
Quickly, one limitation that I think is important to just mention, because our study does focus really on closed and private equity, like traditional private equity and venture capital funds, we don't necessarily have in our data any of the kind of new fund structures that solve for liquidity. So there are a lot of kind of interval and tender offer funds or kind of evergreen funds that are built with a particular liquidity sleeve in them. There's other work that's being done that really measures the effect of that type of liquidity buffer on performance. And that would be another thing that we would want to take into account if we're going to also consider the kind of vehicles that solve for this liquidity problem for individual investors in that particular way.
related to not the evergreen funds, that was one of the other questions that I had. So let's forget about it. But related to this kind of investment perspective, would you advise the investor to look for the good advisor? In a sense, I see your results as that when you invest, you should care about your advisor, regardless of where you come from. The advisor is going to make an impact. So this is the way we can read your results.
Yeah, I think that's right.
Okay, perfect.
Yeah, and I mean, we do see even within the less wealthy individuals in the sample, some of whom have managed to, by skill or luck, match with a very high quality advisor, and that's something that can lead them to have high performance. This often is information that's quite hard to come by when you're evaluating financial advisors, but it is something that would point in the direction of greater disclosure, greater information, so that investors can make more informed decisions when they make those types of advisor selections.
And
Very
my
good.
last question before I leave the floor to Nadia, it's exactly about advisors. Do you have any kind of view or idea what they are actually adding? Is it like, because it seems that they are adding value, right? But through which channel? So is that they do a lot of due diligence? Is it that they have access to different deals? Is it like they construct, I don't know, like is there any kind of at least anecdotal evidence that suggests something is the case?
Yeah, so we would take the results that I showed within the subsamples of funds that are relatively easy to access as evidence that it is not access that is driving the advisor skill. We do think that the results that we have are consistent with advisors paying considerable fixed costs to do due diligence about the types of funds that have been offered in the market, what past performances look like. So we do think that it's more consistent with a view that you delegate to your financial advisor this due diligence component that is costly for you to do as an individual investor with a job and other commitments.
Okay, thank you very much. Yeah, Nadia?
Yes, I have a question. I want to know, do you think the macroeconomic shift with different interest rates around the world could have a significant impact on the risk averse of investor?
So we do, of course, know that over the recent 5 years that there's been a significant shift in the interest rate environment globally. This did seem to provide some headwinds to the private equity industry that it really benefited, it seemed like, from a low interest rate environment over a decade or two, depending on exactly the market they operate in. Your question was whether the risk aversion associate or whether the higher interest rate would affect investors' risk aversion generally.
Yes.
Whether we think investors would be more risk averse.
Yes.
This I don't know that I have a view on. I do think that I guess when interest rates are higher, investors are kind of more willing to invest in bonds and other types of assets. As interest rates become low, there's kind of less difference in the return across investments. And so really, it's possible for this to go either way. I'm not sure that I have a stark prediction for the direction in which this will take it.
Okay, I also have another question. For someone who really wanted to learn more about this subject, do you have some resources that you can share with us?
Yes. So if you're very interested in understanding this market, I think that there are two really interesting places to start. I do think there are a lot of industry research reports that are very useful and that provide great context on how markets are developing year to year. In particular, I think Bain and McKinsey both put out a private equity landscape piece each year. These are great things to read if you're going into a private equity interview. I do think in addition to that, it's great to read like the Financial Times and the Wall Street Journal and pick a couple of articles that are relevant to the industry. That really does help in terms of broadening your understanding of who the players are in the market and what the current kind of trends and challenges that the industry is facing look like. On a personal finance perspective, I did recommend to Laurent and will recommend again a book by my colleague Tarun Ramodori called Fixed. It's a really interesting global view on personal finance and how a lot of the products that are marketed on a personal finance level are not necessarily products that are going to benefit households. So this, I think, is a really interesting look at the financial sector more broadly. And it doesn't talk about private equity specifically, but we can think about private equity in the context of other products that have been recommended to individuals. So I would start with those sources. I think that this is a really, really interesting time to be thinking about disruption and industry changes. So those sources are all good to keeping up to date.
Okay. Thank you.
Thank you very much, Cynthia. As a conclusion, would you say that when I look at your results, I don't have the feeling that we're looking at an industry who is trying to extract the money from the individual investors because it cannot find the money anywhere else. So sometimes we hear this story about, yeah, well, there is no more money, so they have to access another type of investors so that they can continue growing. And looking at your results, I don't see it this way. Could we interpret your results that in the fact that, well, no, this is not by necessity, in a sense, that they have to access those because they have poor performance, they cannot access money anymore? This is slightly different story that we hear there.
Yeah, I have heard this story as well. I do think that it is something that is interesting to consider, but it is not something that I think of as being the primary driver of the investment landscape that individuals have access to. Yeah, I do think that this is simply a market in which really there are a lot of investors. And in particular, as we see globally, more companies stay private and more wealth remain private, that individual investors feel, often rightfully so, that they should have some ability to access in their investment portfolios.
Okay, well, thank you very, very much, Cynthia. I think that was really enlightening, and I think that opens perspective for all the viewers. Our next session for the speaker series of the Future of Finance will take place in a month. We're going to move the topic to decoding sustainable investment strategy, bridging intentions and actions with Ayako Yasuda from University of California, Davis, and the moderator is going to be Sophie Clow. So in the meantime, Cynthia, we wish you the very best, and we really thank you for your talk today. Thanks a lot.
Thank you very much.
Thank you. Thank you very much.